There's this very specific, very sharp kind of pain in the stock market. It's not when a company misses earnings and the stock drops. I mean, you expect that. You brace for it. It's when a company gives you exactly what you wanted to hear. We made more money, we sold more chips, and the market's response is to just, well, crush the stock.
It's the classic beat and raise that's followed by a complete nosedive. It feels illogical. It defies the basic physics of good news.
Exactly. It feels personal. And that is precisely the crime scene we are investigating today with NXP Semiconductors, ticker NXPI. They just dropped their Q4 2025 numbers. On paper, it looks great. Revenue beat, earnings beat. But the stock, it fell off a cliff. We're talking over 5% almost instantly.
And that usually tells us one thing. It tells us the headline numbers are hiding something nasty in the footnotes.
Right.
We're not looking at a simple case of good news versus bad news. We're looking at a real disconnect between the headlines and the actual, the quality of the business underneath.
And that is our mission today. We are not just reading a press release. We are doing a deep dive into a specific institutional analysis report. It's titled NXPI Earnings Feb 2026 to figure out why the market hated this supposedly good news. We're going to be forensic accountants here.
We are. We're going to walk through a 5-part framework, a 5-slide analysis to really separate the signal from all the noise.
Yeah.
Because when the market ignores a double beat like this, it almost always means the quality of the earnings is in question, not just the quantity.
Before we dive in, this analysis is brought to you by StockAnalytics.ai. Get institutional-grade research on over 600 stocks for just $10 a month. Plus, request any ticker and download your own video analysis. Start your 7-day free trial at StockAnalytics.ai. Now, let's get into it.
So to solve this mystery, we have to start with the evidence that fooled everyone at first glance, the headline numbers.
Let's do it. Slide 1, the at-a-glance scorecard.
Right. So this slide is designed to visualize the company's internal reality versus, what Wall Street was expecting. It's that initial litmus test.
Okay, let's start at the top line, the cash coming in the door. For the fourth quarter of 2025, NXP reported total revenue of $3.335 billion.
And context is everything here. That number is up 7.2% year over year, up from about $3.1 billion in Q4 of 2024.
In the semiconductor world, which has been incredibly volatile lately, 7% growth feels pretty solid. It's not that NVIDIA hypergrowth, but it's healthy. That sounds like a win.
It is a win, statistically. Wall Street's consensus was sitting at about $3.31 billion. So NXP came in roughly $30 million higher. That's nearly a 1% beat on the top line. If you're just skimming the surface, this looks like a clear victory. They sold more chips than anyone predicted.
Okay, so the top line's good. They moved the product. Now let's get to the bottom line, the profit. And this is where the story always gets a little more complicated. We have two sets of books, essentially. The GAAP numbers and the non-GAAP numbers.
Right. And for anyone who isn't a CPA, GAAP is the strict, by-the-book government accounting. Non-GAAP is the adjusted number, where the company basically says, well, if you ignore these specific one-time expenses, here's what we really made.
And Wall Street usually loves that non-GAAP fantasy number. So what did NXP report there?
On that adjusted non-GAAP basis, they reported earnings per share of $3.35. That's up 5.3% year over year.
And did that beat the estimate?
It did. The street was looking for about $3.31, so they beat by 4 cents.
Okay, stop right there. I have to play devil's advocate. They beat on revenue. They beat on the earnings number that analysts supposedly care about the most. Why in the world did the stock tank 5%? What is the red flag we're missing here?
Well, it all comes down to a concept called operating leverage, or in this case, the lack of it.
Operating leverage. Okay, let's unpack that.
Think about the physics of a hardware business. You have these massive fixed cost factories, R&D centers, machinery. Once you pay for those, they're paid for. So if your revenue goes up by, say, 7%, your profit should go up by more than 7% because every extra dollar in sales should be mostly pure profit.
Right. The first million chicks pay for the factory. The next million are almost all gravy.
Exactly. But look at NXP's numbers again. Revenue grew 7.2%. But those non-GAAP earnings, they only grew 5.3%.
Ah, I see it now. The profit grew slower than the sales.
Which is the exact opposite of what you want to see. It means the car is driving faster, but the engine is actually getting less efficient. Something is eating up that extra margin on the way down.
So the market saw that lag and just said, wait a minute, this growth is expensive growth.
Precisely. They call it margin compression. And when you combine that with the other number on this slide, the GAAP net income, it gets even uglier. On a strict by-the-book accounting basis, their real net income was actually down 8.1%.
Ouch. So while the adjusted story was we grew 5%, the accounting reality was we shrank by 8.
And that divergence is massive. That's the very first clue that the quality of this earnings beat was low. The market decided to sell the news because underneath that nice headline, the profitability engine is clearly sputtering.
That makes a lot more sense. You can't just look at the beat, you have to look at the quality of the beat.
Yes.
Okay, I want to find out exactly where that money is leaking. You mentioned efficiency problems. Let's look under the hood.
Let's do it. Let's move to the next slide.
Slide 2, the engine of profitability.
All right, this is where we look at the margins to find that leak. This slide explains why profit growth is lagging behind revenue.
And we start with gross margin. This is basically the difference between what it costs to make the chip and what they sold it for.
And surprisingly, this part of the engine is actually working just fine. Their GAAP gross margin was 54.2%. That's actually up a tiny bit, about 0.3% from last year.
So they're not slashing prices. They still have pricing power. That's good. So where's the money leaking out then?
It's further down the income statement. Let's compare the operating margins. This is the profit you have left after you pay for R&D, sales, admin, all that stuff.
Okay, I'm looking at the chart here. The non-GAAP operating margin is a very healthy 34.6%. But the GAAP operating margin, the real one, wow, it's only 22.3%.
That is a massive gap.
It's more than a gap. It's a 12 percentage point difference. In finance, that's a canyon. What on earth could possibly account for a 12% difference in profitability?
To find that, we have to dig into the reconciliation table to find the culprit. And the primary driver of that depressed GAAP number is a $177 million restructuring charge.
Restructuring? That sounds like corporate speak for layoffs or closing down factories.
It usually is. And management excludes this from their core non-GAAP numbers because they argue it's a one-time cost to fix the business. They're effectively saying, hey, ignore this $177 million, we're just tuning up the engine.
But that money still left the bank account, right? It's not imaginary money.
It absolutely left the account. And that's the rub. If this restructuring works, margins should, in theory, shoot up later in 2026. But right now, it's just a big cash burn. This charge is exactly why GAAP income fell 8%, even though revenue rose. The market sees that charge and gets nervous. Is this a quick fix, or is the underlying business broken?
So it's a show-me situation. Management says tune up. The market is worried it's a full engine overhaul. If you spend $177 million to fix the business, I'd expect to see massive efficiency gains next year.
Exactly. If those margins don't expand, then that wasn't a one-time charge. It was just cash incineration. The market is nervous. This is a sign of structural weakness, not just a quick tune-up.
Okay, so we have expensive growth and expensive restructuring, but let's talk about where this revenue is actually coming from. Not all chips are created equal. As an investor, I want to know if they're selling into growing markets or dying ones.
That takes us right to the segment breakdown.
Slide 3, the engine room business segment performance.
So we already established that revenue grew 7.2%, but that growth wasn't evenly spread. NXP has a few different cylinders in its engine.
And based on the at-a-glance data we saw on the first slide, it specifically mentioned that the industrial and IoT, the Internet of Things markets, were showing resilience.
Yes, and those segments are really doing the heavy lifting right now. They're the primary reason NXP was able to post that top-line growth despite some wobbles in the broader economy.
But there's always a drag somewhere. You don't get a 5% stock drop without a weak link. What's pulling them down?
The report explicitly labels communication infrastructure and other as the drag. That cylinder is definitely misfiring.
And I remember back in slide 1, the analyst sentiment was also nervous about automotive deceleration. NXP is huge in cars, right? I feel like every other chip in my car's dashboard has NXP stamped on it.
They are absolutely massive, a dominant player in automotive chips. And even though this report highlights industrial and IoT as the resilience drivers, the market sentiment that sell the news reaction was partly driven by fears that the big automotive boom is finally slowing down.
So you have infrastructure dragging, automotive looking a bit shaky, and IoT trying to carry the whole team. It's a bit of a lopsided performance.
It is. It's not a broad-based rally across all their sectors. It's more like pockets of resilience that are masking some structural weakness elsewhere. And when investors see a beat driven by just one or two segments while the core automotive business looks shaky, they get nervous about how sustainable that growth really is.
It just feels fragile. Okay, let's pivot to something that usually makes investors feel a little bit better. The balance sheet. Are they going broke?
Far from it. Let's look at the financials.
Slide 4. Financial strength and shareholder rewards.
NXP is a cash machine, generally speaking, and they like to return that cash to shareholders. In this quarter alone, they spent $338 million on share buybacks.
Okay, I want to pause on this because this is my favorite part of the analysis and also the most frustrating.
I have a feeling I know exactly where you're going with this.
Conceptually, buybacks are great. The company buys its own stock, takes it off the market, and the remaining shares become more valuable. It's like cutting a pizza into fewer slices. My slice gets bigger.
Theoretically, yes. That is the promise.
But I'm looking at the data here. They spent $338 million. But the total number of shares outstanding actually went up.
It did. The count went from 254.1 million to 256.6 million. That's an increase of 1%.
How is that even possible? How do you spend $1/3 billion buying your own stock and end up with more stock? My slice of the pizza actually got smaller.
It's the hidden tax of the tech world, stock-based compensation.
Explain that for anyone who might just gloss over that line item on a report.
The company is issuing new shares to its employees as bonuses, as incentives, faster than they are buying back shares from the open market.
So they're bailing water out of the boat with the big buyback bucket, but someone else is drilling holes in the hull with the compensation drill.
That's a vivid image, but yes, that's it. And this ties right back to our very first point about earnings growth. Remember how revenue was up 7.2%, but EPS was only up 5.3%?
The dilution.
Exactly. That dilution is the friction that's slowing down your earnings per share growth. You, as a shareholder, are owning a smaller piece of the company, so you get a smaller piece of the profit growth.
That is a huge aha moment. The dilution is eating the growth. That is infuriating if you're a shareholder. Okay, is it any good news on the balance sheet? What about inventory? Are they just sitting on a mountain of unsold chips?
That is actually a bright spot. We always check inventory to make sure company isn't stuffing the channel.
Which is that dirty trick of forcing your distributors to buy chips they don't really need just to make your quarterly numbers look good.
Exactly.
Huh.
But NXP's channel inventory is at 2.5 months. Their internal days of inventory is at 123 days.
And is that good or bad?
It's healthy. 2.5 months is pretty standard. It means they aren't stuffing the channel. The revenue they reported is real revenue.
Okay, so the sales are real, but the dilution is annoying and the margins are getting compressed. Let's look forward. You can't drive the car looking only in the rearview mirror. What is the CEO, Rafael Sotomayor, telling us about the future?
And that brings us to the final part of this analysis.
Slide 5, the road ahead management's outlook and key takeaways.
So the management tone is very disciplined. Sotomayor is using words like resilience and operational discipline. He's really focused on software-defined vehicles and something called physical AI.
Physical AI, that sounds like a buzzword bingo winner right there.
It does sound like it, but it's actually a key strategy. It means chips that can run AI processing right there on the device, in your car, in your smart thermostat, rather than having to send data to the cloud. It's a massive growth area, and NXP wants to own it.
That does sound promising,
Mhm.
but I noticed something a little weird in the guidance for Q1 2026. The GAAP earnings outlook looks, well, it looks surprisingly high, almost suspiciously good.
You spotted the gotcha. This is a classic trap for an unwary investor. If you just look at the guidance table, you might think profitability is about to explode next quarter.
Right.
But it's not organic. NXP closed the sale of their MEMS sensors business on February 2nd, 2026.
MEMS sensors, those are the little accelerometers in phones and things.
Exactly. They sold that entire business unit. That sale brings in a big pile of cash, which gets recorded on the income statement as a gain. It's an other incidental gain.
So it's like selling your car to pay your rent. Your bank account looks fantastic that one month, but you didn't actually earn that money from your job.
That is the perfect analogy. So investors, you have to mentally subtract that one-time windfall to see the true operating performance of the company next quarter. If you don't, you're going to see this huge gap number for Q1 and think the business is booming. And then Q2 comes around, that cash is gone, and you're left disappointed.
It really highlights how much homework you have to do. You can't just read the summary table.
You really can't. That's why we do these deep dives.
So let's wrap this all up. What does this all mean? We started with a contradiction. Revenue beat, earnings beat, and a stock that got hammered.
And when you put all 5 of these slides together, the picture becomes pretty clear. Yes, they met the headline numbers. But when you look at the quality of those earnings, it was what we'd call a low-quality beat.
We've got margin compression, that huge 12% gap between GAAP and non-GAAP.
We've got shareholder dilution, more shares outstanding despite all those buybacks.
And we have a reliance on some really heavy adjustments, like ignoring those restructuring costs to make the profitability look smooth.
Exactly. The market sold off because while the quantity of the money was higher than expected, the quality was much lower.
It's like eating a burger that looks amazing in the commercial, but is a little soggy when you actually unwrap it.
And that leads to the big question for you, the listener.
What should they be thinking about now?
That $177 million restructuring charge, is that a sign of a company in trouble? One that's flailing to cut costs? Or is it the necessary pain before NXP becomes a much leaner, more profitable machine in late 2026?
The next 2 quarters are really going to tell the story.
They will. If that restructuring works, those margins we talked about, that 22% gap margin, should start climbing, and climbing rapidly. If they don't, then that money was wasted, and the stock probably has further to fall. So don't just watch the revenue next quarter. Watch the margins. That is where the real story is going to be.
A fascinating look under the hood. Before we go, a quick reminder. This discussion is not financial advice. Do your own research. This content was generated by AI. Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai. For just $10 a month, you get full access to our deep dive video library covering over 600 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify. Can't find the stock you're looking for? Request analysis on ANY ticker and download your own video within 24 hours. Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings. Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust.